again, everybody. We should have known when you put 2.5 Africans on the stage with a timeline that they were never going to make it. So we do apologize for that one. Thankfully, being the only South African on the panel today, we're hoping that this one is going to work.
I don't know, you have an Italian and a French. I mean, what can go wrong, right?
Sorry, I'll bring some disciplines.
I'm 5 minutes early.
Okay. Okay, so let's try this one. Ladies and gentlemen, we are at a pivotal moment in global markets. Economic shifts, geopolitical tensions, and technological advances are reshaping how capital flows across regions and asset classes. Investors like yourselves in the room are being challenged to rethink not just where they allocate capital, but why, how, and how quickly you can adapt to changing environments. In this evolving landscape, questions around liquidity and volatility have taken on a new urgency. Is liquidity still the reliable safety net it once was, or has it become a limiting factor? Volatility, should it be feared as a risk or embraced as a catalyst for generating alpha? In recent years, private assets have moved from niche to mainstream. Bain & Company projects that the private market AUM could reach up to $65 trillion by 2032, growing more than twice as fast as public markets. Retail investors are increasingly joining this shift, drawn by the promise of diversification and higher returns. Yet public markets continue to be the cornerstone of many investor portfolios, offering transparency and liquidity. I had a brief chat to someone in this room earlier who said, "We don't really think about private markets in a big way in South Africa, because why do you need diversification when public markets continue to do so well?" Valid. Another, however, said to me, "We are full up on public market allocation and are looking for some interesting alternative strategies to complement our portfolios." Another valid point. On that note, I was interested to see on the wall outside that many of you are planning on increasing your allocation over the next 12 months to private markets, a clear signal that today's conversation is a timely one. Today, I'm delighted to be joined by 3 of my colleagues, M&G's Global Chief Investment Officers. Fabiana Fedeli, Chief Investment Officer of Equities, Multi-Asset and Sustainability. Andy Cholton, Chief Investment Officer of Fixed Income. What is that? Sorry. And Emmanuel de Blanc, the Chief Investment Officer of our private markets. Together, we're going to explore the opportunities, trade-offs, and strategies shaping asset allocation today, and what that means for building resilient, future-fit portfolios. Please join me in welcoming our panelists. With that in mind, let's begin. Who am I starting with? Actually, let me start with each of you. Fabiana, I'm going to start with you and going down the row. As a Chief Investment Officer, what is the first thing you do or focus on when you get to your desk in the morning?
Oh, we're going personal now. So actually, by the time I'm at my desk, I've had a whole morning of stuff. So I'll tell you what I do first thing in the morning. I used to be an equities portfolio manager on Asia and emerging markets. So as of now, I still wake up at 5 o'clock every morning, immediately check markets, because that's pretty much the morning in India, depending on the time change, and it is about midday in Hong Kong. And once I've looked at all of the markets, I blast Bloomberg TV, to the delight of my husband. So we have a deal. Until 6:01, I am not allowed to have that on loudspeaker. I have to put my earpods in. But 6:01, the whole house has Bloomberg TV all over the place. And that's my first thing in the morning. And then I'll check my emails. And by the time I come to work, I'm generally pretty relaxed, and I can then get on with things.
Okay. Andy?
I don't get up as early as Fabiana, I've got to be honest. I check the news, I check markets, and then I'll have the context before I open my email, what's happened and how people are being affected by those things. At the moment, it's just to see what the president has said overnight and how difficult or easy my day is going to be.
It's so interesting, we don't even need to ask which president he's referring to. Emmanuel.
Well, I think the notion of desk has changed a bit. I think I probably do a bit of Fabiana, but I've got not exactly the same timing in terms of waking up. So I make sure I've got my 5th espresso down before doing anything. And then I look at the Financial Times. I'm trying to skip through the noise. There are a lot of articles where you reread again and again the same thing, and trying to find those where it's actually a bit more long-term and medium-term, probably because I'm not impacted as much as the day-to-day. And for us, it's probably actually quite toxic to look at this because we need to take a step back and see what are more the longer-term trends. But there are a few publications where you can get those articles that are meaningful, in the longer run. So it's probably just trying to, sanitize and clean up what's happening in the news flow is a big part of that morning routine.
Okay. It's interesting that only one of you mentioned coffee, so I'm definitely with you on that one. Let's shift gears. Fabiana, why do you believe that public assets continue to be a cornerstone in many investor portfolios?
Well, for a couple of reasons. The first one is that, actually, 3 reasons. They have performed very well, particularly equity markets. Secondly, investors have different needs. They have cash flow needs often, and not all investors can wait a very long time to get to their cash flows. And so, they might decide to invest in more liquid assets because of those needs. And then the third reason is because public markets are so vastly larger than private markets and more easy to access. So I believe private markets right now are around 15 trillion, give or take. As of last year, public markets were 232 trillion. And by public markets, I mean fixed income and plus equities. In the year 2024 alone, public equities grew by 15 trillion. So they grew, but the whole amount of private markets. And there's a bit of a, metropolitan legend that public markets have shrunk. Equities used to be 49 trillion in 2014. They're 115 trillion now. Public fixed income used to be 59 trillion in 2014, is 117 trillion now. So they're deep, they're large, but that doesn't mean that they're only part of a portfolio. Any portfolio to build resilience should be diversified, and I think both public and private markets should be part of a portfolio.
Interesting, and I think that the growth of public markets it's the same point I mentioned earlier, that as markets continue to grow, investors think, well, it sounds great, but actually this works for me, it's comfortable, I understand it, and it's liquid.
Over the last 5 years, the S&P 500 has performed better than private equity, right? And over the last 3 years, even the MSCI All Country World has performed better. So it's pretty comparable, and you don't always get paid back for your liquidity risk. But that can change at any point in time, so both should be part of a portfolio.
Yeah. Andy, how do you view the role of passive investing within public markets? In an environment where efficiency and cost are key considerations, are there areas where you believe that passive strategies make more sense, and others where active still adds significant value?
You won't be surprised to hear that I favour active strategies, given I work for M&G. But I think, particularly in fixed income, it is important to highlight why it's important. If you go back to the statistics that Fabiana shared, that growth of fixed income markets, you could describe it another way. You could describe it as growing indebtedness of those issuers, whether that be governments or corporates. And unlike in the equity world, where if you're participating in those rising markets, you're participating in the success, the growth of those equity stories. In many ways, in fixed income, as an issuer becomes a bigger part of an index, it's because its debt is growing, its indebtedness is growing, so it's not necessarily a good thing. And often a lot of the problems we find in the bond market are as a result of over-leverage, whether that's in the credit sector or in the government sector. I think the other nuance in fixed income, without being rude about equities, but given you were giving private assets a pop, I'll fight back a bit on his behalf.
I said it was good to have private assets in your portfolio.
Fixed income is quite a complex asset class. Different parts of the capital structure, different tenors, different currencies, even from the same issuer. You think of a large bank, they'll issue in multiple currencies, multiple parts of the curve, multiple parts of the capital structure, and they'll all price differently and have different risk rewards, different payoffs in the event of default, etc. So you've got that. You've got the new issue market. I don't know the stats on how many equity IPOs we've had this year, but we probably get, maybe not on a Friday now, but we'll be getting 10 new issues probably every day in Europe, another 20 in the US. So whilst we deal in basis points rather than percentage points, that's effectively an IPO opportunity every day, which index funds don't participate in. So there's a whole load of structural advantage, I think, that active managers have. I think probably the one area where active is more challenging, although I have to say my government team do a really good job of this, is the single strategy type portfolios, which are very narrow. There's a trend in some parts of Europe where you'll have a European government bond strategy between 5 and 7 years. It's not giving you an enormous amount of flexibility, so you're probably not worth paying a manager for that. Maybe go passive. But I think everything else, there's so many moving parts in the market that active is the way to go. And I think what we're seeing now, particularly in these periods of transition, and I'm sure we'll get onto Liberation Day, and I've heard it in some of the previous panels, that's when you need to have that flexibility, because the world you thought you had is no longer the world you have.
Interesting. And I mean, I think it goes to that point that the active-passive discussion is not just a cost discussion. Actually, cost is the least of your decision criteria here. Emmanuel, what are the primary advantages of investing in private markets compared to public markets? I mean, obviously, we all know the liquidity, but how do you convince an investor who's not sold into kind of paying up for, or rather taking up the time, liquidity concerns, risk concerns, blowout concerns that you often see in private markets? What do you say to potential investors to convince them?
Well, I think they're just the years and decades of the private markets generating excess returns. So that's pretty basic, right? If you can actually afford to surrender some liquidity, it seems to be weird not to try to access something that should give you, or historically has proven to actually yield more returns. So that's 101, I think. And the issue for the retail world, frankly, there's a question of just social justice, you could say, which is why would you actually only give access to the sovereign wealth funds, the big institutions, to that excess return versus the retail. So that's the challenge, and there are obviously some pitfalls about what one calls democratization of private markets. But there's a question of justice to give people that access to fair returns, as well as fundamentally the cheapest return or risk-adjusted return benefit you can get is through diversification. Now, diversification from public markets is very interesting because it comes in some of the types of assets you can access, obviously, and in a world where tech becomes crucial, this is one area where private markets can grant you access, which is not straightforward necessarily in public markets. You can have some exposure, but not necessarily the same. So it's a question of exposure to parts of the economy where public markets probably underweigh it or is not giving you the full gamut of options. But there's a question of chronology or sequencing of timing of markets. There's a time lag in private markets versus public markets. and depending on the asset class within private markets, you are between, a month to 12 months away from the cycle observable, either in the fixed income or public equities markets. And that's crucial because that allows you actually to to smooth a bit, your return, to bring some inertia. So the swings tend to be less violent. They exist in private markets as well. And maybe also just to play around with your portfolio. So what we've observed is that in a market that's adjusting downwards, it's actually not bad to be in public markets because it reacts faster. There's usually an automatic regulation in the private markets around that. As you get, a market that adjusts downwards, you tend to have more volatility. In a high volatility environment, the M&A volumes shrink, and therefore less paper comes out, and therefore there's just less to be had. And what you deal with is the legacy position, the legacy commitments, because those deals take longer. So it's just how do you extricate yourself sometimes, depending on that. And by the way, volatility to some extent, just a proxy is beyond a VIX at 30. There's no deal in private markets in reality. It just goes off. So the sweet spot is that 25 to 30 is perfect because that means that the high yield bond is in tatters, and you can just basically, the private markets is basically taking a bigger share of the issuances, of the activity, brings that inertia, and you grab a bit more. So that's quite interesting. But in that downward spiral, you probably want to be flipping a bit more to public anyhow. And actually, it's interesting. On the way back up, you absolutely want to be in private markets, in my view, because of the legacy and the commitments. You actually, by the time you agree a deal and you close it, you're sitting on a gain on paper on a mark-to-market basis. You don't do mark-to-market, in most of the books, but you do valuations, and so that's just helpful in terms of smoothing actually, the performance of your portfolio.
I want to ask you a follow-on question to that one. You mentioned briefly the democratization. English is not my first language, folks, so go easy. Democratization of private markets. In that, what benefit does that offer to, for example, like a retail investor? Or what risks do you think that possibly mitigates in private market investment?
So I think the benefits for me, the prime two are this diversification, just the lower volatility that you gain, and that's simple, an exposure that you wouldn't have otherwise. So that's the benefit, and then the excess spread that you should expect. But the liquidity calls in personal lives can be more violent than you'd wish for. And therefore, you don't have the same predictability necessarily of your cash flows as you would in as an institution would, because we're not necessarily all regulated in the same way. So that's probably the biggest issue. I think the one issue that I would highlight is one concern that people should have is all around that liquidity personally, and also the level of diversification you can actually achieve within a strategy in private markets. So do you need to be in there for 5 years, or actually do you get a diversification from day one? So what we've definitely tried to achieve in our products is that for investors that come from more retail background, is to give them an exposure on day one on a portfolio that's already ramped up, so they don't have to wait 3 years to get that diversified private markets portfolio, but we give them exposure to a seeded portfolio from the first day.
Okay. Thank you. So onto the benefits and challenges of integrating both public and private markets. I want us to now think about how investors can effectively balance these asset classes to enhance portfolio resilience and longer-term returns. Fabiana, you, in your space, have got the ability to be a little bit more reactive. The longer-term decision is kind of made there, and you're kind of stuck until you're out of it. But how do you kind of combine the ability to be reactive with the risk of kind of being too reactive sometimes in public markets?
So, first and foremost, if I may, I just wanted to address one point that both Andy and Emmanuel made, which I think is very important, which is the issue of accessibility of markets. And so you were earlier you were mentioning passives within public markets. And in my opinion, the reason why passives have done so well is not because they're passive per se, but because it's so easy to access in ETF, as opposed to go through mutual funds and all the regulations or mandate, et cetera. So, as we get tokenization, as we get active ETFs, I think that will be a game changer for markets, will democratize even more access, and will also somehow change the balance of the passive versus active discussion. On on how you balance public and private, I'm actually a big believer that 10 years from now, any portfolio will be able to invest in both private and public assets, but understanding what's inside those assets. Because I think we're getting this the whole way wrong. We don't invest in private assets because they're private and better than sliced bread. We don't invest in public assets because they're public and, they're so liquid. We need to invest in the companies. So if we like a company that is listed in public markets, we buy into that company. If we can't find that company in public markets, but we can find it in private markets, then we buy into that company. But we buy into the company. We don't buy into a concept of an asset class. And that is really what the world needs to start working on, so that our clients get a much better risk-adjusted portfolio, as opposed to having kind of random sleeves that are divided by asset class, with you don't really know what's inside them. But there's one powerful component when it comes to public versus passive, and that public versus private, and that is that every company before being public has been private. And one of the things that we've been doing at M&G, and I think we can do this because we are large enough to have very well developed and differentiated asset classes, but small enough that the three of us can just sit down and brainstorm. What we've been doing, we have been created, for example, one private to public strategy, whereby you invest in the private company, and then you help that company become public, and then you harvest the alpha on the two sides of that IPO. Because generally, a private equity fund will either leave some money on the table before the IPO to make it successful, or will try to reap every single penny before the IPO, and then generally the company is too highly valued for when it lists. But if you are there as an asset manager and you're literally going over the two sides, then you can reap alpha on whatever side of that IPO it is. So there is more of this that we need to do. And I think clients will buy into this, because you're not looking at asset classes, you're looking at what's actually in there.
Interesting, thank you. Andy, many South African investors remain underweight in global fixed income, even as more international investors have increasingly allocated to this asset class. In your view, what do you believe is driving this cautious stance? And given the relative attractiveness of South African bond yields, is it a positioning that still makes sense, or should investors be rethinking their global fixed income exposure?
That's a good question. So I think most countries, investors have a domestic bias in fixed income. Fixed income's the lowest risk asset class. It's appropriate that you'd have a domestic bias. I spent over a decade in the US. Same is true there. Same in the UK. Same in Europe. South Africa's no different in that sense. And I was listening to the panel which Gareth was on before. clearly from a yield perspective, competing with real yields of 6% in South African govies is pretty tough. There's not much else that's going to have that and the domestic bias, which gives you a sense of reduced risk, I guess, if you're a South African investor. Having said that, I think there's two other factors to consider. The first is the opportunity set more broadly. As I said before, if you expand, fixed income is a very diverse asset class. You've got yield curves, credit versus govies, structured credit, seniority in the capital structure, and then you add currencies on top of that. That's a formidable range of opportunities that a good manager can access from an alpha perspective, if not from a fundamental yield perspective. And then the final point is diversification from a liquidity perspective. So if you cast your minds back to the end of 2022 in the UK, and don't worry, I'm not one of those Brits who still thinks the UK drives financial markets, because it doesn't. But it is worth using it as a case study of when liquidity really matters. Because in fixed income, 99% of the time, 99.99% of the time, liquidity doesn't matter. We can trade our bonds, the banks are there, it's fine. Go back to Liz Truss's short-lived premiership in the UK at the end of 2022. All these UK pension plans thought they were pretty well set when it comes to liquidity. They've got an awful lot of government bonds, UK government bonds, both in nominals and inflation linked. And yes, they had some LDI structures and some derivatives, but they've got this core allocation to govies and high quality credit. So everyone's sitting pretty in their risk models, it looks great. But unfortunately, they all had the same asset allocation. And so when they're all trying to get liquidity to pay the margin calls, there's no one at the end of the phone, because people sometimes forget banks are not fiduciaries. You call up XYZ Bank and try and trade some bonds. If they don't want to trade them, they won't answer the phone. So there was this real liquidity crisis in the UK government bond market, not because there was anything materially wrong longer term with the UK, which we had a questionable government at the time. It was much more about everybody trying to exit through this small door. And I spoke to a CIO of a very large UK pension plan afterwards, and she said to me, well, what lessons should we learn? What should we do differently? So I explained my view that everyone's pretty much advised by the same consultants, as 5 to 10 big consultants. You've all got broadly the same asset allocation. You've got the same allocation to privates versus equities versus credit and govies. And so when you need liquidity, it's a bit of a problem because you all need liquidity at the same time. So I said, and there's a fully funded pension plan. So I said to her, you should buy some Brazilian local currency government bonds. And she looked at me like I was nuts. Like, what are you talking about, Andy? I'm a conservative, fully funded pension plan. My primary responsibility is to pay the benefits of the members. I said, yeah, and you need diversification, because I guarantee you, when the UK was blowing up, and I'm sure it's true in Cape Town and Joburg as well, people around the world would be looking at it on their Bloomberg screens or on CNBC and going, oh, look, UK's having a few problems. And then they get back to work and carry on. And I think that's the crucial thing with fixed income. Yes, it's liquid. Yes, it's big. But it's not always liquid. And the time that you really need it is when you really need that liquidity. So the challenge is to get investors to look beyond their domestic market, just at the margin, to have those different options of liquidity. And what we've seen is we've seen diversification to dollars particularly, but emerging market debt flows have been negative over every year for the last 5 years. We don't see many people investing in Asia fixed income. We had our first large client from Italy make an allocation to one of our Asia bond funds. First time I've seen a European client buy Asia fixed income in an allocation sense rather than a tactical sense for a long, long time. So I think that's the real challenge. Fixed income's liquid, it's always liquid. Everyone thinks it's always liquid until it's not, and then you've got real problems. And it might only last 2 weeks, but those 2 weeks might be pretty crucial. So that, for me, is that final ingredient of why any investor should look at diversification from a return perspective, of course, from a risk perspective, of course, but also from a liquidity perspective. And that's where I think it comes in.
Cool, thank you. Emmanuel, from your perspective, what is a reasonable allocation to private markets for a diversified portfolio? Does this differ whether you're a retail investor or an institutional investor? And which sectors or industries within private markets currently offer the most promising opportunities?
So on the first point on what is the reasonable one, I think it's very much, you know, looking at what your time horizon is and your liquidity spectrum.
Yeah.
So think about endowments and pension funds. You know, those long-dated obligations, they should be there, and they are, right? I mean, I think the Canadians are a good example where, you know, some of them had like 50 to 70% of private assets exposure, and that's actually served them well. It's a very well-funded system. The Australians have done a very good job as well. And I think some countries in Europe could actually have done well in allocating or funding their system in a similar fashion. So you've got that on one hand, and the retail investors is really the opposite of that, because actually, if you look at their portfolio, you know, probably for quite a few of you, you already have a private asset, you know, and that's your house, your flat, and that's pretty illiquid in reality. When things go down, and we've been there in 08, 09, and other times of difficulty, so you already have an allocation in reality. We might not get a fee out of it, but unless we're renting it to you, but you don't own it as a result. But so it really is that ability to absorb the liquidity shock, and usually maybe, whilst you may not have many savings the earlier in your life, the more ability you've got to actually look for the long term, and therefore, you know, it's just a question of timing. So that's a simplified way of looking at it, and I think where people are settling in is, okay, probably a 10 to 25% for the retail is probably a good place. For insurers, 20 to 30, and pension funds can be, you know, anywhere between 20 and 60%. So there's a really a lot of inconsistency or diversity within the investor universe. On the sectors, I think one thing that I find really attractive in private markets is we've seen a volatility of the inflation. So we talk about high inflation. Well, really, okay. What really is most shocking, I think, in the last few years, has been the uncertainty of the inflation going forward, and the value of hedging yourself against that. And some of the real assets offer that, yes, over a long run, but actually it works over a long run, and that's a value that you don't pay for it really, and therefore that brings that. It's also present in the private credit. Actually, a lot of the private credit paper is floating rate, and the inflation actually flows through the nominal rates, and therefore you get an inherent protection as well there. So I think that's one. You know, it's not a specific allocation to a given slice of the private markets, but you know, it's an important dimension when you look at what are you exposed to and where you should gain. So the big themes, I think, there are driven by what's going on in this world, which can be a bit messy or chaotic. I think the first one is we've got a rebirth, really, a reboot of Europe on two sides, which is it needs to be more autonomous on energy security, and its economy needs to get restarted to be more dynamic. So that's a massive opportunity in pretty much every strand of the economy, but specifically private credit, because you're going to need to fund the whole economy. To get the defense spending, really, it's about changing and moving some of the existing manufacturing capabilities need to be converted. So we're going to need primary capital, as opposed to private credit or the capital markets funding, you know, one private equity purchase of a given asset and the usual LBO or the takeout of that debt in the public markets. We're talking about primary credit to actually fund capital expenditure, and that's actually new in Europe almost. We've got a new level of capital spending that's happening because we need that conversion to happen. And also this is happening obviously in the energy sector, which is crucial for the independence or a lower reliance on imports of gas or other form of fossil fuel. So we need energy to be, localized and to be less dependent. So our resilience, the resilience and autonomy of Europe. So that's a big topic. It's been accelerated quite clearly by German politics, or the change of policy in Germany in March, April. They voted a partial removal of the debt brake and very significant spending. So the trajectory of the European economy is changing. We're talking about another 15 basis points on the average Eurozone GDP growth over 2030, 1.5% higher GDP in 2029 and 2030. It's very significant because it's incremental, and that creates opportunities across the board. And I think we're well positioned to get that. But for investors, that's really a game changer, because there's a sense that Europe needs to catch up. Where there is an issue for Europe in particular is in that trade war or economic war. Europe had the talents, but suffered from a shortage of capital. It might sound weird, but actually the European capital markets are inefficient, they're very fragmented, and they're not big enough. The talents and we have entrepreneurs and talents, but they've tended to, once you get to a certain size, they've taken off and gone to the US to look for that scalable capital. And that's what needs to happen to create an alternative to the US tech ecosystem. And that's the other opportunity. The other big leg of the opportunity is you can't have a successful economy going forward without actually grasping the opportunity of the step change in tech.
But it's clear, is a clear exemplification of what we were talking about earlier. Europe, there's this rebirth of Europe, there is this spending. We know it's happening. Some of it is coming from a super clean balance sheet, which is a German one. You can take advantage of it, both on public and on private markets. And it's really a matter of which companies you can access. You can access a lot of the innovative, smaller companies through private markets, because you can't do that with public markets. And then you can access the larger, more established companies that are taking advantage of these flows through public markets. So again, you can literally look at the one opportunity and tackle it from both sides.
Yeah. Interesting. Folks, I know we are about 15 minutes past your lunchtime. Sumaya's getting very cross with me in the front here, so I'm going to close off with just some closing comments. I'll leave the Frenchman to the end. Closing comments on these two, and then we'll let everybody go to lunch. So last closing comments, just really, if you had to leave the audience with one thought about the future of investing in public or private assets, what would it be?
Stop thinking about investing in private markets or public markets. Think about the companies you're investing in, the underlying assets you're going to invest in, and that's how you're going to make your returns.
Thank you. Andy?
There are going to be lots of government bonds for sale in the next few years. So yields are going to be attractive, positive real yields, whether in South Africa or in the UK or the US. And that's the hurdle for these guys with their fancy equity investments to beat, because the risk-free return is going to be much more attractive than it's been when we had that period of low rates and quantitative easing.
And that's why multi-asset class is such a beautiful space to operate. Emmanuel?
So I would say be obsessed about a given date in the future, let's call it 2030, and think about what it's likely to look like and what will matter to be on the right side of various scenarios at that point in time, and work back what that means today. But I think more than ever, we're observing fundamental shifts in the way the world is organized or disorganized, and on the economic front as well, with obviously tech changing the way we consume, we do about anything. So I think on both sides of the equations, I think we almost need to take a step back and say, well, let's not take anything for granted. What could it look like? And I think 2040 is really far away, but in 5 years' time, what could it look like, and what am I doing about this today?
5-year strategies, real yield, and focus on the company as opposed to public versus private. Ladies and gentlemen, thank you very much. Thank you to the panelists.